Welcome everybody to Sobel Insights. My name is Brad Muniz and I'm a partner at Sobel & Company. Sobel Insights is a weekly series where we provide some brief information on various topics. Our goal is to keep the sessions to 15 minutes. At this time, we do not offer CPE. If you have any ideas for topics or for potential speakers, please feel free to reach out to me. Today's topic is hard markets. Our speaker is Rich Skorupski. He's an executive vice president in Meeker Sharkey. And Rich, I've heard of hard markets, and it's usually with the stock market, it's a bull market or bear markets, but I haven't heard much about hard markets as it relates to the insurance buyers. Can you explain hard and soft markets to us?
Sure, and I appreciate the opportunity to join in this forum with Sobel. So thank you very much. So a hard market is typically representative of increasing insurance rates, which typically affect, obviously, the premiums that an insurance buyer is going to pay for their coverages. However, a hard market tends to go beyond that. Other characteristics of a hard market are restriction in coverages, a reluctance by carriers to offer competitive quotes against the incumbent carrier, increased underwriting review by underwriters at insurance carriers. So that might be indicated by underwriters starting to ask a lot more questions, even though they're familiar with the account. They might be looking at your property rates more closely, or property levels more closely, which again impacts the premium. So in a hard market, you tend to see a re-underwriting of accounts. What we've seen in this hard market, particularly with coverages and limits, is carriers have started to restrict limits on umbrellas. So we've seen carriers take $1 million umbrella limits down to $5 million. We've seen carriers be very hesitant to offer higher directors and officers liability limits. And we've particularly seen the cyber market get hit with a restriction in coverages, particularly in the crime area. And there has even been some talk in the insurance industry of carriers eliminating ransomware coverage because that's driving a lot of the claim activity. Cyber criminals know that if there's insurance, we're going to go after the insurance. So that's even been discussed at the federal level with the legislators and the insurance carriers. A soft market, on the other hand, is the complete opposite. We see carriers vying for market share, so rates tend to go down, which affects premiums. We tend to see a broadening of coverage. We tend to see carriers offering higher limits and a more lax underwriting approach. So it's the complete opposite from a hard market. The good news for insurance buyers is that hard markets tend to have a very short shelf life. They typically last 2, 3, maybe 4 or 5 years, but that's 5 years is kind of on the outer limits of a hard market. Soft markets, on the other hand, can go on for 10 years. So while we're experiencing a hard market now, it should be short. The outlier in this whole situation, obviously, is COVID and its effect on the insurance industry.
So you just killed me, because I went into accounting because I really did not like macroeconomics. And as you were talking, all I started thinking was the trough, the cycles that everybody goes through. And so you said that we're in a hard market right now. I'm a neophyte in this area. I'm not surprised because of everything that's going on in the world. Then you mentioned ransomware, and I'm on a small board and we got hit with ransomware. A small board of a nonprofit, and we got hit with it. Are we in a particular, the stock market does this, and it'll have these sometimes, but are we in a particular point in a cycle that you think that we should be anticipating coming out, or are we haven't hit the bottom yet?
Yeah, what's interesting about where we are with regard to the current marketplace is insurance carriers have actually been struggling to raise rate for several years. I would say that was characterized by 2017 and 2018, where carriers were coming to us seeking to raise rates, particularly in the auto lines, because historically that's been a loss leader for insurance companies. They haven't been profitable. But that was tempered really by the insurance market, the competition in the insurance market. And we were able to basically negotiate those rate increases down or have them eliminated. That changed in 2019. Carriers wanted rate, they weren't willing to negotiate, but we were seeing more single digit rate increases, somewhere middle single digit to high single digit. Again, pretty much across the line, but again, really targeted on the auto line. 2020 is when I would say that the really full-fledged hard market hit, exacerbated obviously by the pandemic and its effect on the economy. What we were seeing in 2020 was double-digit increases across most lines of insurance, and in some cases, triple-digit increases, particularly in the area of umbrella liability and directors and officers liability. So as we moved through 2020, we had some very hard, difficult conversations with insureds. There wasn't a lot of carriers that were willing to look at new business. Kind of everybody was kind of a wait and see attitude. That started to change in 2021. We're already starting to see rate modification. So there you go, hard market, right? Started in 2019 and it's 2021, and we're starting to see rate moderation. It's still rate increase, but we're back to more single digit rate increases with carriers. And we're also seeing carriers who are willing to take a look at accounts that they haven't been willing to look at, historically. So, while there is competition, the competition is still looking for some type of a rate increase on the terms that they're offering. So, by example, we may have a renewal with a client and they're looking for a 15 overall % rate increase. There may be a couple of lines that are single digit, D&O, maybe, still double digit increases. So the overall rate increase for the account is 15. The other carrier may come in and offer a 5% increase over expiring. So, there's rate modification. There's opportunity to keep those premiums down, but we're still in what I would classify as the hard market in terms of carriers looking for the rate, and there's still restrictions. We're not seeing the umbrella market come back with higher limits. D&O is still a very troublesome line of insurance. Carriers are reluctant to still offer higher limits. They're offering restrictions in coverage. And quite frankly, the cyber market is entering its own hard market at this point. We're starting to increase significant in the cyber coverage and rate restrictions, as I mentioned earlier. And I think that that's going to continue because of the threats that we're experiencing. They change on a regular basis, and the market is still filling itself out with regard to cyber.
Yeah, and as you were talking and explaining this more, I started figuring, I asked you a very broad question of where we are in the cycle, and it all depends on probably the type. I mean, the health insurance is probably granite hard, solid, oak tree hard. That's not going to ever be softened probably, but the other ones have their own little cycles, and with cyber, the way that's constantly changing. What can insurance buyers, and particularly nonprofits, that we deal with a lot of nonprofits. I just mentioned I was on a board that got hit. What should they do to navigate hard markets, would you say?
So hopefully this isn't a foreign term to the insurance buyers on this call, but there's a term in our industry called a loss ratio. And in its simplest terms, a loss ratio is earned premium that a carrier earns on an account. So $100,000 in earned premium from January 1st to January 1st of the following year against incurred losses. And incurred losses are losses that are paid and losses that are reserved. Carriers look at reserves the same way they look at paid losses because, quite frankly, they don't know where that loss is going to go. And the trend over the last couple of years has been that these claims have gone upwards. They haven't gotten down. There's another term in our industry called social inflation, which is the fact that basically society is angry at large institutions and people in power. So they're settling claims if they go to jury trial very high. Most insurance claims don't go to a jury trial for obvious reasons. But that's still having an effect on the plaintiff's attorneys seeking higher demands for claims. So it's incumbent upon an insurance buyer to protect your loss ratio, do whatever you can to keep your loss ratio down. A good rule of thumb in our industry is a 60% loss ratio with a carrier is break even when you consider overhead expenses and things of that nature. So anything above 60%, you're not attractive to an insurance company. Anything below 60%, you're very attractive. And carriers, typically shoot for like a 30% loss ratio. So anything 30, 40% is considered, an attractive account. So how do you protect that loss ratio? Well, you invest in safety. And I think most insurance buyers at this point in time have gotten that, and they invest in some type of safety initiatives. It's very important, though, if you're going to, invest those dollars, to understand where you should need to invest them. And you do that by doing accident trend analysis. And we'd suggest that you should look at your losses on a quarterly basis and see where you're having the claims. Are they property related? Are they auto related? Are they workers' compensation related? And what's causing it? To do that, we talk about what's called a root cause analysis, and that's where an insured really looks at a claim and figures out what happened. All too often, claims are reported to the insurance carrier as say a slip and fall. Well, what happened? Was there water on the floor that the maintenance crew didn't clean up properly? Was there, inclement weather? Was the employee wearing the proper footwear to work? A classic example is, we'll dive into a slip and fall on stairs, and what caused the injury? Obviously the slip and fall on the stairs, but was the individual carrying, items in their hands that precluded them from stopping the fall? What could have been a minor claim became, $100,000 broken leg or $200,000 broken leg. And if insureds haven't considered it, we think establishing a safety committee is an incredibly proactive way of having accomplished all of these items, because a committed safety committee is going to do all of these things, come up with ideas as to how to improve, the safety. And, in this market, because we're in a transitional market right now, remarket your account. If you're an attractive account that has a pretty good loss ratio, now is a good time to consider taking your account out to other carriers and seeing if you can at least mitigate the rate increase that your carrier is talking about on renewal. The irony of this market is incumbent carriers are seeking rate on their existing book of business, regardless of how profitable it is. But those same carriers will go out and be very aggressive on new business because they know that they can be opportunistic. So we've basically remarketed all of our accounts over the last 2 years. Last year out of pure necessity because the rates were so significant. This year to keep the carriers honest, quite frankly. And we've moved accounts because there are better deals out there. So
it's interesting. And now, we do a lot of cyber training in our office because all the activity that's going on. And I'm sure it's important, to keep the company safe, so people aren't clicking on emails, but it also helps for insurance purposes, to make people aware of what's going on. And I hate the emails that come out to try and trick us into clicking on something, but they're warranted and they're very helpful. So over the next few years, what will the next few years look like, you think, for insurance buyers in general?
Well, as I mentioned earlier, hard markets don't really have a long shelf life. So what I think insurance buyers can expect is a continued moderation in rates. With the exception, I think we're still going to see some reluctance for carriers to offer the higher umbrella limits. Not all carriers are taking that approach, but there's a fair amount of them in the marketplace that are. Directors and officers' liabilities continue to be an issue, whether it's a for-profit organization or a not-for-profit organization. It's just a very difficult line for carriers to underwrite. And from a nonprofit standpoint, really the issue there is not so much D&O claims. 95% of the claims against nonprofits under the D&O policy are employment practice liability claims, part of that policy. And there's a lot of activity with employment practice liability claims. A lot of employees are bringing those claims, for wrongful termination, age discrimination, whistleblower type of claims. That I think is going to continue. And I mentioned social inflation earlier. This is an area where that particularly impacts claim settlement. So that's going to continue to still be a relatively difficult line. But the other lines of insurance, I think we're going to start to see rate modification. You might expect some flat renewals over the next few years. I don't know that we're going to get to super aggressive underwriting again for the next year or two, but eventually that's going to come back. I think, again, carriers are going to look for market share, particularly if we see the pandemic truly recede and the economy rebound. Cyber, all bets are off with regard to cyber. For the reasons I mentioned earlier, we're still seeing an increase in threats. We're still seeing a lot of claims. What's interesting about cyber, which a lot of people on this call might not know, one of the reasons it's a good idea to have cyber is not so much for the claim payment, but the services provided. A lot of times the claim, we had a ransomware attack for one of our clients where the actual ransomware payment was about $75,000, but the ancillary services, the forensic IT, the forensic accounting, the legal, upwards of 6 figures in that area. So the cyber policy gives you access to a lot of great services, which if you were to have to pay for them on your own would be exorbitantly expensive, but you can cover them under the cyber policy. So that's where we see a lot of payments being made, and that's going to continue. And that's going to continue to drive the cyber market.
Great. So we heard everything you said, but your screen froze. So but we're right at the end anyway. So I want to thank everybody for tuning in and paying attention and listening. Hopefully you learned what hard and soft markets are and start watching. And as Rich said, start looking at your policies, market your plans, and speak with somebody like Meeker Sharkey and talk with them and find out how they can help you to do better with your insurance policy. So thank you very much, Rich. Thank you very much for giving us all this information. And I look forward to hearing from you again in the future.